you heard Trucost mentioned a minute ago. We're going to talk about the role of data and financial data in particular in sustainability. Please welcome to the stage the CEO of Trucost and the head of innovation at S&P Global, Mattison, and Dmitri Sedov. So last fall, I think October, S&P Global, actually it's the Dow Jones S&P indices, part of S&P Global, if I got that even partly right, bought Trucost, the UK-based research and data firm that we've had the great pleasure of partnering with for about 5 years on our State of Green Business report and in other ways. Dmitri, why did S&P buy Trucost? What did you see in that opportunity?
Yeah, thank you, Joel, for this question. Well, first of all, S&P Global has too many great brands within, so we all get mixed up in all these names. But of course, S&P Global is a fairly young brand from the marketing perspective. We changed the name from McGraw-Hill Financial earlier this year. But of course, the brands that S&P Global hosts or the home to are quite well known. It's S&P Dow Jones Indices, it's S&P Global Ratings, the largest credit rating agency in the world, and it is S&P Global Market Intelligence, which is Capital IQ, SNL Financial, Platts, and so on and so forth. I think, I'll answer your question. I will dodge your question in a way, if you don't mind.
Everyone else does.
I will actually say this. The big question in my head is, why did we not buy Trucost back in 2008 when we started collaborating with them? And, there are so many different good reasons today to partner with a company like Trucost, but it would have been fantastic had it happened 10 years ago. Now, as I talk to people here in this room over the last day and a half, it's clear that everybody is very pumped around this room and kind of gathered and talks in unison about the issues that are facing sustainability. But like my good friend Paula DiPierno from CDP says, it's like you lock these people in the room and they all scream very loudly, but nobody can hear on the outside. And I think many people will agree that over the last decade, maybe even two, we've been talking about this, but we haven't seen the progress happen as rapidly as many have hoped.
And this being, what do we do with all the data that all these companies are putting forth or that you're finding from other sources, right?
No, absolutely. And I think it's the fundamental misalignment between what people in this room are really working hard on and what investors in the financial markets expect. There's clearly a level of misunderstanding that sustainability is not just a social choice, but it is a requirement. But the questions such as how do we actually demonstrate to investors that more sustainable companies actually do lead to better returns? How do we demonstrate to investors that fiduciary duties that they have to uphold to their clients, such as pension funds and endowments, would not be compromised? In fact, they would be enhanced, and at the same time, they would not have to sacrifice the yield. They could still produce better returns for the risk profiles that they've committed to. And ultimately, the biggest question for us as a company today is how do you balance out the supply and demand in the sustainability finance? The balance is completely out of whack. Yeah. There is no equilibrium, right? You have, $60 trillion committed to UNPRI by a roster of who is who of signatories of the financial world. But on the supply side, there's just not enough investments. There's not enough paper. And so the question is, how do you balance that equation? How do you produce more investments, put them into the market, and ultimately drive for that ever-elusive greenium, right? The premium.
Well, let's get to how you do that in a minute. But Rich, maybe I mean, we started with the assumption that everybody knows what Trucost is, and I'm sure that's probably not the case. So maybe give, first of all, the elevator pitch. But along the way, talk about how you see how sustainability meeting capital markets and how that shift, what's happened over just the last couple of years that this has sort of maybe reached an inflection point?
Yeah, so Trucost, at Trucost we work with companies and with investors. And the way in which we work with both parties is really to understand environmental performance and ESG performance more broadly. And we were founded on the principle, actually, that capital markets were lacking really rigorous, robust analysis that would allow investors to make reasonable investment decisions. And in fact, it's still the case that we're facing massive market failure. It's 10 years since Lord Stern said that climate change represented the biggest market failure known to man, and that could represent literally GDP loss of up to 20% globally if we don't solve this problem. And part of the issue is an information gap and also a mismatch of expectations. So if you start at the top of the investment chain, you have asset owners like pension funds and endowment funds who have a long-term time horizon. And somehow, as you move through that investment chain, that time horizon becomes very, very short, and in some cases, seconds, if you're talking about quantitative trading. And then right down towards the assets, you start to get longer term again. So, everybody in this room has long-term assets that they're investing in, be they power plants or, even the supply chain and things like that. So actually, we have a complete mismatch in the middle of that set of decisions that is not driving capital towards sustainable investments or into assets that the companies are managing on behalf of shareholders. And really, it's this mismatch that was the fundamental analysis that came out the Financial Stability Board's Task Force on Climate-Related Financial Disclosures, TCFD, that Peter Backer mentioned yesterday. And it's really that report that highlights the fact that there's a complete mismatch between what asset owners expect, the pension funds, how asset managers are analyzing information, and the kind of information that can be provided by companies to enable that analysis. What we really need to do is enable capital flow that is sitting on low yield right now, waiting for investment in sustainable assets. And that's what we need to unlock right now.
So, Dmitri, is that the imbalance, the supply-demand imbalance of sustainable finance? Talk a little bit about what you mean by that, because I'm not sure that's clear to everybody.
Sure. Well, I think Richard articulated it wonderfully. Today, I think there is a verified interest on the part of the large asset owners on the pension funds and endowments that actually sit on trillions of dollars to put their money towards something that is sustainable, that is greener, not necessarily 100% green, but better than the alternative, if you will. And the big question is, how do we meet that demand with supply of available investments? To do so, you need an industrial strength system that is transparent, that is comparable across asset classes and across regions. And you need a system that actually everybody can agree on. And today, we don't have that system. Now, S&P Global Ratings, a credit rating agency, has been in the market with their credit ratings for the better part of the century. And today, it's not even a thought. How do you assess default risk? Well, you look at a credit rating. That's how institutional investors think about credit risk. We need a system that is similar to that in sustainability. How do you assess sustainability risks? And forget risks, how about assessing sustainability impacts?
So give an example of how this might play out, an actual product that might help solve this imbalance. Mm-hmm.
Well, so on the product side, of course, S&P Dow Jones Indices has been out there since, I guess, 1999 or 1998 with their Dow Jones Sustainability Indices. It's a family of about 50 indexes that provide passive investors and retail investors with fantastic opportunities to put money towards more sustainable investments. And Trucost has been a great partner in our carbon efficient indices. So on that side, on the equity side, on the passive investment side, I think we have it pretty well covered. The biggest asset pool, however, is bonds. It's 2/3 of the financial markets, and it's $80 trillion. So how do you tap into that? Because that asset pool is certainly managed by professional asset managers. That's institutional money, and it's the active side of the investment equation.
So these are the green bonds that
So that's the green evaluations that we actually, this week, we formally launched but proposed at G20 last year and sort of reinforced in Marrakesh at COP22, a framework for evaluating any type of bond for its relative greenness. We do believe it's a game changer because today the only thing that's available out in the market is a set of frameworks that look at 100% eligible projects that can be financed through bonds. That's your labeled green universe. We would like to take the markets further. Green finance has done wonders. It certainly has grown, but it's still $100 billion. You have this gap of $100 billion of supply and $60 trillion of committed demand. Mm-hmm. And we can't get there through just eligible projects. So green evaluations from S&P Global Ratings is actually a very interesting proposition to the markets and to corporate issuers in this room. We don't really need to think about a bond being 100% green. We can think about all of the amazing initiatives that are being conducted by people in this room at the corporate level as business as usual, but are not recognized by investors as being green. So they cannot really aggregate it for for their portfolios and say, well, we have good investments, we have, I don't know, $60 trillion worth of bonds overall, but there's a percentage of them that actually are financing initiatives such as energy efficiency, such as better use of water, such as reduction of pollution. And that's what we want to recognize with green evaluations.
So Rich, what are the implications for the people in this room? In other words, does this happen entirely passively from their perspective? It just happens that you now have the ability to in effect monetize or aggregate a lot of the great work being done, or is there something that they need to be doing differently? Or thinking differently about it?
Yeah, I mean, I think there's been a huge amount of work on scoping out sustainability, and everybody in this room has contributed massively to that. To my mind, it's actually harnessing capital markets as a force for good. You said yesterday that companies can be a force for good. I actually believe that capital markets can be a force for good. There is capital sitting there waiting to be invested. So, and what do we really need? We actually need a magnitude higher level investment in sustainability.
Can you give some numbers just to give us a sense of how big we need to be aiming?
Well, I mean, let's take China, for example. China's climate plan every year requires $600 billion of investment. 85% of that does not come from the Chinese government. 85% of that has to come from private capital markets. So in China, and that is China, they have measured quite precisely what that looks like. If you go across the world, that number is probably bigger, so 90%, 95% even. And certainly in the US, probably 99%, I don't know. But the point about this is that in terms of the scaling that is required to meet sustainable challenges, that will need a lot of capital. That's billions and billions of dollars. Last week, a French pension fund issued a low carbon mandate of $5 billion, just last week, and that's not unusual. This is happening all the time now. So you have asset managers, you have fund managers who are looking for investments. So there's an opportunity here for everybody in this room to present investable opportunities at scale to the market to allow the market to invest. So I actually think the job here is to connect sustainability with the financial community within companies. And really, I actually believe that every company in this room in the next year should probably be thinking about issuing a green bond.
Yeah. So, or I could actually say a bond that could be assessed for its relative greenness, which is all of a sudden exposing so many more investors to this potential investable opportunity.
So Dmitri, we talk about sustainability and then we talk about green, which is just one part of sustainability. Is there an opportunity, or do you see this moving also to include social opportunities, or is that even investable in the same kind of way?
Absolutely, and I think the way I think about ES&G is in terms of operational risk and operational opportunities, as well as companies' ability to manage these risks and perform better for the benefit of their shareholders. So whether it's green or it's social, it's a combination of both. I think we should and will assess it on its own merits. ESG speaks more to the corporate behavior than, let's say, green finance that is more focused on the actual use of proceeds. And so you sort of need both in the market. If you're an oil and gas company with investments that go towards improving the environment, that ought to be recognized, and that's your use of proceeds, and where you say, well, we've invested $2 billion into clean coal or coal to gas conversion or whatever it is, that's fine. we should not say, well, no, this is not 100% green. Oh, you're a miner or an oil and gas company, therefore you should not be even in this room. Just the opposite. So that's the green evaluation. ESG speaks more to the broader corporate behavior and more to the combination of various factors that management puts in place in order to be more sustainable as an organization. And we certainly are looking to assess those as well.
Great. Let's take a question from the audience. Elaine?
Yeah, we're getting quite a few questions on Twitter as well as our virtual. One question is a two-part on Twitter because 140 characters wasn't enough. Investors use a small number of sources for data and often want very small numbers of ESG metrics. Many are reported but not in the 10K. Are we solving the problem of no data or laziness of investors?
Rich?
I think it's true that investors want simplicity. And I think that one of the findings of the Financial Stability Board's report was that actually some of the information that's been presented is not that usable by investors. So I do think they need simple formats. They need information that they can incorporate within models, within multi-factor models, within net present value calculations, whatever way in which they're calculating value. But what they're really looking for, and the recommendations of that report I would really recommend everybody reading, is they're looking for scenario analysis. They're looking for a connectivity between sustainability indicators and financial outcomes, because that allows them to justify the investments they need to make to scale and transition our economy to a more sustainable world. So really, simply put, yes, they are looking for very clear data sets presented in a format that makes sense to them, but there may need to be further work done on exactly how that data is presented.
Great. Let's take another question.
Yeah, this one is on Twitter. How do you identify opportunities and interest in investors with aggregate funds, ETFs, mutual funds, large cap, et cetera?
These are the things that we can invest in in our retirement accounts. And that's what you're talking about, these kinds of products?
Yeah, well, if I understand the question correctly, if you're a retail investor and you just want to know what the offerings are, there are plenty of offerings out there in the market that cater to the sustainability investor. I think what we are trying to do is take it mainstream with institutional money. It's not a matter of lacking opportunities for very targeted thematic investment. Those have been around for a while and they're quite well documented. The question is, how do the rest of the issuers, the 90% of the issuers out there who have a variety of different business models that may not necessarily fit that perfect sustainability mold, can demonstrate to investors their sustainability and drive for greater returns on their assets as a result of it, and that's what we're trying to accomplish.
Well, this party is just getting started. I think it's so, not just your partnership, but this whole field. I think we saw green bonds, one of the really good news parts of the State of Green Business report this year in terms of the market uptake of those, or the issuance of those. And it's going to be really exciting to watch you guys figure out how 1 + 1 = 11 in your case, just numbers, guys, and what the bigger opportunity is for all of these companies. So we'll look forward to that. Please join me in thanking Rich and Dmitri. Thanks, guys.